Hey, everybody. Well, I think we've given a couple of minutes for as many people as possible to join us. So welcome once again to July's webinar. We're delighted to have you join us today. For those of you who don't know me, I am Sam Fowler-Holmes. I'm a partner in the Trade, Commodity and Export Finance team of Sullivan in London. And I'm delighted to be joined today by Daniela Barrdear, who is a counsel in the team with me. And we are together going to be trying to, dare I say, tackle the thorny issue of plugging the trade finance gap. Daniela and I were discussing this earlier today, and I came up that I think throughout my career there have been three mainstays of trade, and that's been sanctions, fraud, and the trade finance gap. None of which, unfortunately, are good mainstays or ones that we want to be talking about many years after we first started talking about them. But having just gone through the first half of the year and the conference period during that first half of the year, where there was again a focus on the trade finance gap, we thought it was probably a very relevant topic, as always, to try and deal with. So that's what we're going to be looking at today, Daniela.
Yeah. So what are we going to cover? I think we're in the context of what is the trade finance gap. We're going to look at what it is, how it gets defined, how it gets used. Also looking at why it is that it exists. Why it is that it is a topic that is worth discussing. And in that context, we're going to look at who are the players that are looking to plug the gap or are coming into this space. We call them impact. Well, we're looking at impact funds, but we're also calling them with a broad brush umbrella of impact financiers. These are development finance institutions, multilaterals, other development banks. They get called a number of different things, all with their own separate focus. And then we also wanted to touch on export credit agencies almost as a separate beast, a separate type of institution. So that's what we will cover in this session.
Okay, so let's start, I think, from the beginning and talk about what we mean by the trade finance gap. I'm sure many of you will know that Asian Development Bank has published a number of trade finance surveys that they've conducted. And dare I say, you sort of each time a new one comes out, you sort of look at it through closed hands to the extent you can to see what figure the trade gap has been identified as. And for these purposes, the trade finance gap is effectively, if we boil it down to its simplest form, it's the difference between the level of financing or level of trade financing that is being requested in the market on a global level, and then setting that against the actual level of financing that's being provided. So what is the number of unmet demand for whatever reason it may be, and we will be exploring that. And rather soberingly, the latest survey that was published by Asian Development Bank in 2003, which was as of 2022, puts that figure at 2.5 trillion. Which, just by comparison, if you go back 10 years ago to 2014, that figure was 1.4 trillion, and in 2020 it was 1.7. So a huge jump in that number in the 2 years between 2020 to 2022. Now, if you cast your minds back to that, there are immediately some very obvious factors underlying that. The COVID-19 pandemic, which, even though the effects of that are still lingering on, were obviously significant in that 2-year period. We also have the war in Ukraine, and then a range of other macroeconomic and global economic factors that we're just not going to have the time to go into, but that's a huge increase to go from 1.7 to 2.5. And the reality is, when you look at the data that's being provided here, is that this gap is impacting all levels, all participants in the market on the borrower side. So this is not just an issue for SMEs. It's not just an issue for your mid caps. It's not even for your multinationals. It impacts all of them. But it's also clear that it impacts the SME space much more than any other space in the market. And what we're going to try and do today is try and unravel some of this a little bit, because we have talked about this at such great length, and understandably there needs to be a focus on it and there needs to be action, but trying to consider who it is that's in this space at the moment, trying to address it.
And also, why is it that trade finance is being particularly affected?
Exactly. So then part of what the survey is looking at from Asian Development Bank is the reasons for rejection, because what we wouldn't want anybody to take away from this webinar today is any kind of suggestion that we are saying that every transaction is financeable. We've done enough webinars and hopefully spoken with enough of you over the years to know that you always have to have a viable transaction. And there are a lot of things that go into making a transaction viable. And from our side, that will include things such as the structuring of the transaction and making sure that you've got the right collateral package if you need one, that you're financing in the most appropriate method for the relevant customer. And I think we all accept that not all transactions and not all borrowers are actually viable. But there are some stark messages that come out of the survey, and these are the same messages that have been there for a number of years. But if you see the slide, the second point I think is a key one, is that 40% of the reasons given by banks to ADB as to why they were rejecting requests were things that are quite honestly tackleable with the right concerted effort. So serious KYC concerns, poorly presented applications, insufficient collateral or no collateral, or being in an industry or more likely in a country that's high risk. Some of those things, you know, the trade lawyer, and I'm sure the trade practitioners, for you, when we talk about collateral, you know, on the one hand, we talk about self-liquidating trade structures, you know, follow the goods, follow the money. But then to talk about applications being rejected because there was insufficient collateral, well, either the underlying transaction is viable, in which case the collateral is what you should be financing, and you follow that. This question of insufficient collateral seems, you know, immediately a bit at odd and at tension with that kind of core tenet of trade of being self-liquidating. And interestingly, as you can see, only 6% of the respondents said that it was because the transaction itself was not profitable enough to process. So I think that goes to demonstrate that although each of these are significant concerns, and KYC and the regulatory regime that our clients work in definitely is a key factor in impacting the ability to reach particularly the SME market, but it's not a reflection that the SME market is the ability to have positive underlying transactions that can do exactly the same as you could do in other jurisdictions or with bigger entities.
Yeah. But then why do we need to concern ourselves with this? You know, it is, I guess it goes a little bit beyond. There are deals out there, or there is finance out there that is actually not being extended.
Yep. And I suppose if you're playing devil's advocate here, you know, the question is, you know, does the gap matter? And, you know, we could sit here and say, you know, we have a thriving trade finance, you know, global trade finance market where there are plenty of participants on all levels who are making money and are capable of having a successful trade business, whether that's on the lending side, on the borrowing side, trading side. But this gap is clearly only going in one direction. And I think we have to recognize that the trade industry, perhaps more so than any other industry, has the ability to make a positive global impact on the lives of billions of people, on improving, you know, access to services, access to goods, financial inclusivity, social inclusivity, on a global level in a way that, quite frankly, few other industries can say that they can. So, whilst I say devil's advocate that, we could sort of put our head in the sand and say we can still be profitable without worrying about this, but that simply isn't the approach we can take.
Yeah, and I guess this goes now to why it is that we wanted to talk about who we are seeing in this space, and why we thought it would be relevant. You can't talk about the trade finance gap without saying, okay, who are the players? Who is actually financing or providing that finance? And I guess in that context, it's we are in this talk going to focus on what we like to call impact financing. We have the IFC's definition of what impact financing is that financing that actually seeks to achieve a wider goal, an environmental impact, social or economic development. And you have a number of different players in this space. You have the development finance institutions. In the private sector, you might have like impact funds that also playing a role. And it is quite interesting to see quite a big rise in these players' commitment to this financing, especially during COVID. We saw that they took up a large share of the financing in trade finance. But are we seeing anyone else?
Well, and I think, my impression just on a personal level has been that when you look at these questions of impact financing and who should be, whose role is it to reach out into these markets, to be focusing on wealth creation and reducing poverty and all of the things that, well, for example, that the UN's Sustainable Development Goals that all of the nations committed to in 2015. There is this perception that, well, this is the public sector. This should be done at national level, regional level, global level. This isn't for the private banks, the corporate banks, the other trade participants, of which there are very many. This is the realm of the DFIs and the multilateral banks. And there is great merit, as we're going to look at, in the role played by the public sector. But I think the message we are seeing coming out more and more now, and certainly we would very much subscribe to, is that, like the trade market itself generally being big enough for all types of players, certainly in the impact financing and the development financing sphere, you have to have both the public sector and the private sector. We cannot do this in silos or isolated and say, well, this is my type of financing because I am a corporate bank, and this is my financing because I'm a DFI. There has to be that collaboration. And I think we are starting to see that more and more now in what I guess we would term blended finance, which is your mixture of both private and public financing. But I suppose today we're going to focus more heavily on the sort of the public sector side. I think it's fair to say.
Yeah. And even, I mean, the point that you make is right, that it's not about looking at one or the other, because even in the context of the last couple of years, where we have seen DFIs take up a wider share or a great share of the financing that is being put in place, even with that increase, they're still not taking up a large percentage of the financing that are, for example, being made for sustainable development goal purposes. Their percentage in that space is not the majority.
Yeah.
It's certainly not even like 2/3. So the private sector does still have quite a large role in the lion's share, I think.
Yeah, no, I think that's very, very fair to say. So I think let's have a look at, as I say, what we're calling sort of the umbrella term of impact financiers. I think in terms of impact financing at the moment, we see this sort of dominated by the DFIs and the multilateral financial institutions or multilateral development banks. But certainly there is a growth of sort of the private sector impact funds who are specifically doing this type of lending. And indeed, I think there is a growth in some of the larger corporate banks doing that lending as well. But it is, as I said, perception-wise, I think still being seen as the DFIs or the multilateral development banks. And part of that is that these types of institutions have very specific mandates, both in terms of the geographies that they can work within, and their sector focus. So to give you an example, BII, which is the UK's DFI, very much has a focus on Africa and I think at the moment Southeast Asia, albeit these mandates can obviously vary over time, and those types of institutions may well have sectoral focuses as well.
And those mandates are public, and so they
Exactly.
can be held to those standards as well.
Which I think is a very good question, which we'll come on to, isn't it, in terms of how do we demonstrate this impact? But I think the area that these impact financiers, where they really excel and where perhaps they stand slightly differently to some of the other players in the market, is their in-country knowledge, their market knowledge, often accompanied by a presence in those markets, with also a mandate typically and a willingness to take on additional commercial risk that as we can make some of these transactions just unviable for corporate lenders.
Yeah.
And that's both sort of even at the local level, some of these banks, they just don't have that ability to be able to finance the need that they have in country. And some of that is even as basic as, if you think about the level of financing that's needed for some of these transactions, sometimes it's below 6 figures. Below 7 figures. So, and for many of our client base, that just isn't feasible. The amount of time that goes in, and when we're thinking about the challenges that the ADB were referring to with respondents, so regulatory issues, sort of country risk, whether that's liquidity risk or political risk. The KYC burdens that big banks are dealing with can make a lending of that level just unfeasible. So that's part of the issue. And I suppose some of the benefits as well is that, do you think it's fair to say that particularly DFIs and multilateral, the relationship side is different?
Yeah, very much. I mean, one of the things that you mentioned is that they may be on the ground for a little bit longer. They would look at that. There might be a policy focus, let's say in a particular region or even in a particular country. And that means that they have that knowledge, like that in-country knowledge. And one of the things that has been interesting to see over the last few years is that you had DFIs that were in country, almost being the first lenders of record for a particular SME at the time, or a company at that time that has grew enough to warrant Western bank syndicate role to be played. So like an increase in the financing. But then for whatever reasons, political unrest, it meant that financing was no longer able to be made by the Western banks, who had to move out of that region. And now it is these DFIs again, who are the only ones that are providing financing. So they're there for a longer term. And they may have that greater knowledge and be able to, let's not say get around, but mitigate some of that time, the time that it takes to onboard that client or to get comfortable with the risk because of that greater knowledge of the area of the space.
And I suppose that given that many of the DFIs are sovereign owned or are effectively indirectly sovereign owned in most cases, it means that there is that political drive to be able to stay with a market and with a borrower or a geography through sort of bad times and good. Yeah. And that's not to say in any way that, when we talk about relationship, that is very much what the finance sector is based around. But there are transactions that there is no doubt that those in the private sector would be required for the various sort of parameters that they work within to look at exiting arrangements in a way that the mandate that a DFI has enables them to stay there. And I think to be used as a stepping stone, exactly as you said, you know, this is about collaboration. And what I think we're looking at here is a way of and hopefully if anybody from a DFI is on, will agree with this in the sense that to go into markets to demonstrate it is possible to do business there, to then be able to exit at the appropriate time, to then allow private financing to be coming in, whether that's alongside the DFIs, the multilaterals, the impact funds, or whether it's more specifically on the sort of private lending by itself. And I think, you know, we've talked to some of this slide already, but I suppose other things that we notice is that because of the potentially different outlook and commercial risk appetite, you know, it's not uncommon to see, you know, some of the lenders being able to do that on an unsecured basis. So immediately that lack of collateral doesn't become an immediate obstacle if there is a viable business, or the collateral package is perhaps a bit less than you might have with if you were looking at doing it on the private lending side. So I suppose, Daniel, obviously we've kind of gone around quite a lot of information there, but we touched on DFIs a little bit, you know.
Yeah.
Can you tell us a little bit more about that?
Yeah, I think it would be helpful because we do have been speaking about them almost in a general context, to just explain who we mean by DFIs, like the development finance institutions. These are entities that are there actually to support the private sector, specifically in developing countries or emerging markets. They usually look at low capital projects, and they are there. Their mandate is to provide financing to borrowers who are not able to obtain it from commercial lenders. They are actually there to plug in this finance gap, as they call it, but it is the other finance gap, I guess, that, as I hear the buzzword quite a lot. And from the DFIs, they look at the development finance gap to be plugged. It is financing those projects where there is a development aspect to them. So I think we just put a few examples of who we mean by these DFIs. They could be multilaterals, or they could be bilateral DFIs. You know, we have Proparcos and FMOs of the world, the BII in the UK, of course, with whom we are very familiar. Then you also have these multilateral DFIs like EIB and the IFC. I think the IFC is still the largest DFI that we work with. Yeah, so maybe we can speak about how it is that these DFIs actually provide finance.
Yes, so I think, I mean, this is the exciting bit, I guess, as well for the lawyers in terms of this is our day to day, isn't it? This is when hopefully you need us. Yes, it is on structuring how the financing can be provided, and I think across impact financiers generally, you see a range of often quite innovative ways of ensuring that financing is being provided, and each institution, whether it's a DFI, a multilateral, or an impact fund, will have potentially its own preferences or the ways that it is able to provide this type of financing. So
very preferred products, and the products will change.
Exactly, and the products may well vary, I guess, from borrower to borrower, or market to market. So we certainly see direct lending, so the impact financier lending directly into the end borrower, and you sometimes see that being done on a bilateral basis, but also not uncommon, I think, to see syndicates of, particularly in the DFIs or the impact funds, may well work together. Sometimes it's a true syndicated lending. Other times it might be syndicated more in the sense that there are common terms underlying the facilities, but each is actually its own individual facility with its own sort of specific commercial terms.
Very much, and especially when they are part of the syndicates, that you often see there being side letters put in place or separate relationships being put in place directly between the DFI and the ultimate borrower, because there are specific considerations, conditions that need to be met that are really irrelevant for the syndicate.
Yeah, no, I think that's very true. And obviously when you have that, it brings in different issues. So if there is a collateral package, you're looking at who's going to perform the security agent role, how are you going to take enforcement actions and other decision making. So that can obviously, those are the same types of issues that you have to think about with any kind of syndicated lending. But as you rightly say, there are, in the way that you can structure these deals, different issues to consider, perhaps because of the nature of the lenders. There's also what I call indirect lending. And I suppose what I mean here by that is, if you take my point about some of the value of some of the financing that's actually needed by individual borrowers, sometimes it's just not practical for one reason or another for any impact financier to provide that directly. So what they might do is, if there's already somebody in country, it might be a microfinance institution or some form of cooperative or whatever it might be, they may finance into that entity as an intermediary, who will then be responsible for the in-country distribution of those funds. And I think we'll probably touch on one of the challenges that comes with that type of structure on measuring impact, but that's certainly one they can do. There are certain, particularly DFIs out there, where I think equity investment is one way that they particularly like doing it. So taking some form of shareholding in the underlying entity. And then a couple of other ways we've seen participation arrangements. Again, that's a preferred approach for some, whether that's participation arrangements where the DFI, for example, is actually the seller or the grantor of the participation, or that the DFI is willing to effectively sit in the back seat behind either a private lender or a private impact fund. And that could obviously be structured. We've talked about participations in other webinars, but lots of ways that could be structured.
And I think historically it has been quite let's call it an easy way or a very quick way to get that financing into the hands of the borrower, but through an established lender, through the established financial institution, who already has a loan in place, or who is already going to take the risk as on board of the client, and the DFI can simply come in and support that transaction, and perhaps enable for better terms to be extended to the borrower, for cheaper financing to be extended, but then also for greater capital to be deployed.
Exactly, and I think that's something I suspect we're going to continue seeing a growth of, and I suspect also with the private sector looking at ways of taking risk in transactions that perhaps they are not in position to structure, but are able to participate in. And then another, I think, key way is guarantees, which obviously can be structured in a number of different ways, but particularly with the multilaterals, I find that they will have guarantee programs that again facilitate private sector lending, but with that additional level of credit support that makes a transaction viable for the private sector. I have mentioned, I mean, this is sort of more innovative, I think, for some of the DFIs. BII, for example, has a sort of experience of establishing entities that effectively allow a conduit for making financing when there is an identified gap and an identified beneficial development impact, if you can provide financing to a particular industry, particular market, but where there isn't somebody to lend into.
So they set up the SPV.
Exactly that. The DFIs have shown they're willing to take, and I think that's important because it shows the commitment to not just being able to provide capital, but actually taking steps to be able to set up the infrastructure to do that is key. We've mentioned a couple of times about some of the quirks and some of the issues to think about, measuring impact, etc. So what are some of the considerations, particularly with working with DFIs?
Yeah, like you mentioned earlier, one of the greater roles that we are seeing DFIs take on are this provision of guarantees, and financial institutions are very much taking up these guarantees for the purpose of meeting CRR requirements, like the credit risk mitigation. The reason Mark Norris, another partner at Sullivan, and I did a talk, a very detailed and much more technical discussion about CRR. It wasn't boring. It was fascinating to a lot of us, but it was highly technical. But if you want to watch that, it's a March webinar, and it should be on our website, I think. But that was looking at very much the credit risk mitigation and whether or not a lot of these guarantees met the requirements of CRR, because there are a lot of considerations to be had in that context. But I think taking a step back, you do need to look at these institutions, who they are, what they are, and one of the things that we have found recently, for example, is that a lot of financial institutions are wanting to work with DFIs, but if it is a particular institution that they're not very familiar with, or one that they haven't looked at it before, that, let's call it onboarding of the DFI, or getting to know that partner entity, has taken quite a long time. And we've been advising on very various levels. For one of them, for example, is like, how do you enforce against that DFI?
And I think that's definitely an issue that I think I've encountered, where, as I mentioned earlier, if there's, very often these are government owned, whether fully or majority, at the multilateral level, many of them have immunity or questions of immunity. I suppose the question for you is, to what extent is, sometimes people see immunity and immediately think, I've got a problem.
Yeah.
I
won't be able to.
Exactly. I suppose the first question is, we are working in an industry with these entities that are specifically there to support this business. But what are your experiences in trying to navigate what is obviously clearly a sensitive issue when people are doing an exercise of, when we act for lenders, part of the due diligence is, can I sue my borrower? Can I enforce my security? How does that work?
No, immunity is a really big topic, and you often only come across it, for example, at the back end of your loan.
Yeah.
You have this waiver of immunity language that you're not really sure whether or not you can bring proceedings against it. And I think that the short answer to it is, it depends on the institution. The immunity that is granted to that institution will be very much set out in its charter, in its in the documentation that has been put in place to set up that institution. Often these are treaties, and the immunity granted is quite specific for the majority of them. And it does not mean that proceedings cannot be brought against them. It might mean that you could not enforce a judgment that is obtained on their assets. You cannot turn up to IFC's offices and take possession of any of IFC's assets. But you can bring proceedings against them, or it might mean that you can only bring proceedings in specific courts. So for example, for EIB, you have to go to the ECJ, to the European Court of Justice. Is the only place where you could bring process. But these are what institutions need to keep in mind, is that these are commercial contracts. These are contracts that are within the powers for these institutions to perform. And so they will be binding themselves to those obligations. And if they do not comply with those obligations, then process can be brought against them for that compliance. So it is, although it requires a little bit of looking into their treaty documents, the documents for establishing that institution, there is often a very specific reason for it. There is immunity from very specific purposes, which are often outside of the transaction.
And I see, obviously, you've referred to monitoring and reporting requirements. I feel very much like ESG that we're in the territory here of this is one of the key challenges, isn't it, for both sides of a transaction of this type, whether you're on the lender side or whether you're the borrower, because identifying what the impact is and then making a sort of qualitative and quantitative assessment, it's incredibly difficult, surely. And in terms of, what are we talking here? Is this are you expecting additional reporting obligations then for this type of lending that we might not see, for example, in private lending?
Yeah, very much. I think if we take the borrower side, first of all, so if you are on the receiving end of this financing, you will need to comply with often a very specific report. The form of said report will be provided for you. What is expected will be quite laid out. Then you still need to put the monitoring process in place to complete that report. And this isn't to say that this isn't able to be done, but it is quite laborious. It takes time and it might take resources that the borrower does not have. At the same time, this is all very transparent. I think when entities sign up to these loans or enter into these arrangements, it is quite clear what is going to be needed. On the other hand, when you look at the lender side of things, one of the let's say obstacles, or one of the greater consideration that needs to be made is, again, for the monitoring of looking at what your borrower is doing, and then the suppliers, and looking further down the chain than you may have wanted to do or even decided to carry out in your transaction. You may not, for example, in supply chain finance, you may not be concerned with what the supplier is doing if you are purely booking this on the risk of the buyer.
Mhm.
But if you have a participant or a participation coming in from a DFI, you will be asked by that DFI to look into that supplier, to carry out KYC requirements on that supplier, which you would have never done before. And then also provide reports on that supplier, which again, you wouldn't have been monitoring it. At the same time, this is opening up a greater capital relief or capital maintenance relief. So there are pros and cons to going further, or to having to look into this a bit more. The other issue, I think, was that when we are looking at the guarantees, a lot of financiers will be looking for that cover to meet the risk as they had outlined it on day one. You have a lot of eligibility criteria that needs to be met in order for that risk to be covered. And often meeting that eligibility criteria is very clear on day one, but then during the life of the transactions, things might change. And the financiers need to be putting processes in place to monitor that compliance with the eligibility criteria, which is again not something that you may have considered when you were putting the transaction in place, but you do need to consider it now because you are looking to, achieve CRR or capital relief.
Okay, so I mean, I think the takeaway from it is really that there are huge benefits, I think, to those who are able to work with impact financiers, whether you are on the sort of the borrower side seeking to take finance from them, or in the private sector looking to engage with the public sector to participate in a transaction or make available a transaction. I think, what this is probably a very appropriate time then to just consider, obviously, another key sector of this area, Whether they necessarily would fall under the umbrella term we're using of impact financing is perhaps a bit more questionable, but export credit agencies and ECA financing, we couldn't speak about this without obviously touching on them, I don't think.
Yeah, exactly. I think that's right. And they're often bundled up together, let's say, even though they have a very different a role to play. So when we talk about like what is ECA financing, we're looking at entities that are state owned, and they are looking to support the export of goods from their own home jurisdictions. They were put in place and were initially designed, let's say, or strategically designed to support those exporters. They are looking to provide their exporters a benefit, but then also provide benefits to foreign buyers for using those exporters, or opening up the market for those exporters. And they're also there to alleviate a lot of those obstacles, I'll say, that may be put in place when an exporter is looking to carry its markets to a new, or carry its products to a new market. But then in terms of like, who are these ECAs? They have the backing, in particular, of their home state. They are institutions who are either fully state-owned or are subsidiaries of a state-owned entity, or they might be private institutions who have purely the finance backing of their home state. They can as well lend directly or indirectly, and in the same sort of structures as we had seen with DFIs, but they are not multilaterals because they are not supported by a number of states. They're usually just one state focus. And they're also not development finance institutions because they are not really focused on development. They are focused on supporting that exporter.
I'm just going to pick up on that point of the exporter. Is that still, certainly when I started in the area looking at export finance, it was very much a case of supporting the exporter by funding a particular contract, or and often these were sort of long-term contracts, or it might be a series of contracts in a program, but which were all along the same kind of terms. Is that still the role that ECAs are performing, or are they branching out more into other types of roles?
Yeah, they are actually. I think like with this increase in almost like a desire to plug in this gap, I think we have seen the ECAs bring, or basically increase the range of products that are available, and they are becoming a lot more active in supporting strategic programs. So not so much looking to support the exporter per se, or that export. It is now looking a little bit beyond that. And for example, they are looking at untied financing. So before, you used to require there to be a tied to a specific export contract, and only then would financing or support be granted from a guarantee, for example. But now it goes beyond that. It is looking to support trade finance more widely, making that supply chain finance a little bit more resilient, rather than supporting an export. And in that context, for example, we can see what recently there was a very big deal supported by Euler Hermes of Trafigura, not so much looking to support an exporter per se, but really just looking to bolster that supply chain finance, resilience, looking a little bit further down the line. I think the other thing that we are seeing as well is just the provision of greater flexibility to SMEs, where the financing is not so much directed to a specific export, but it is looking at supporting specific markets and SMEs. So a great example is the JEF program, the UK JEF program, and that is really providing guarantees to banks who are gaining greater access, or the banks are financing of trade finance facilities that are supporting SMEs. So it is no longer about just supporting that exporter.
And I think this is a very important point to be made, which is that the very adaptation of the role of the Export Credit Agency is recognizing this gap that we have, and seeking within the mandate that they all have, as you say, because these are state-related entities typically, whether they're state-owned or privately owned, but sort of with direction from the state. It's about trying to plug this gap, and there has to be an awareness, is my view on this, that people are pushing in the right direction, but there has to be a frank conversation here that we aren't doing enough as an industry, because if we were, the gap would be going down, it wouldn't be going up. And hopefully for everyone listening today, the takeaway message is obviously for those of you who sit sort of on the borrower side, it is an introduction to the different types of financiers in the market. For those of you who work for those types of financiers, it's perhaps a plug for the work that you're doing, and the positive work that you're doing, but also for the private sector. And we are seeing this, and we know we work with our clients in the private sector who use export credit agency support, or who are actively involved in what might typically be seen more as the domain of the public sector in the impact financing. But this collaboration is key, and it requires the drive of all of us, I think, to ensure that one hopes that the next time we see the Asian Development Bank deliver the survey, that perhaps the news will be less bleak than it was in the 2023 survey. But I think at that point that we've sort of given us a few minutes should anybody have any questions. We do appear to have a couple, which we will now try and pick up. But if anybody does have any questions, please, if you're familiar with Zoom, use the Q&A functionality. For anybody who needs to drop off, can I just say thank you once again for joining us. This is the last webinar before the summer. We will be back again in September. I suspect we will hear from many of you over the coming weeks, but if not, we obviously wish you all a very good summer break. But just take a quick look at the questions. So one very good question here, Daniela, is about how can the Western commercial banks overcome restrictions in country where you're not allowed to provide cross-border financing, which I suspect is a question that someone's been thinking of for quite a while with this going on. I mean, I think this is targeted at the regulatory regime that many jurisdictions have, which impact the ability to lend in country. I mean, I suppose my initial thoughts there are that sometimes there has to be a realization that the world in which we live in, there will be restrictions that mean that certain participants cannot immediately be involved. And then that's where you are looking at the political side of this, the lobbying side of this, in that if a country has regulations that make it difficult for outside financiers to be involved, you are naturally limiting it to the local banks or the multilaterals. And there is obviously a role, as I hope we've described today, for those entities to perform. But it's very difficult for outside financial institutions to support business in that country if the regime doesn't allow it. But what I think I would say is that although there are certainly plenty of jurisdictions we work in that have regulatory requirements that make it more challenging. They don't necessarily prohibit it.
Yeah.
And that's the thing, is that there is prohibition full stop, and there's more difficult. And our job is trying to say that the more difficult shouldn't be the point to which we stop.
I think that's exactly it. And often, what we have seen in a lot of jurisdictions where it is a little bit more difficult, actually partnering up with the DFI or becoming part of that, the group or syndicate of lenders does almost give you that ability to meet those requirements, or not certain, but meet those requirements and provide the financing, but with a partnership. So with someone who might know exactly what it is that needs to be done in that region or in that market.
Exactly. Well, fantastic. I think that was the main question that we've received. So I can see just in the background that the sun is shining for once in London. So for those who are London based, we will let you go and enjoy what may be the only day of the summer. And to everybody else, thank you once again for joining us. And we look forward to hopefully seeing you all at the next webinar in September.
Thank you.